Three, two. Hey traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video for December 11th, 2022. And we are just a couple of weeks away from the Christmas holiday. I know a lot of you that are listening in do celebrate, so hope you're getting all your shopping done. And for the rest of us, we have to take into account that next week is probably going to be the biggest week in the FX market. So I'm going to today give you my playbook for not only the FOMC, but really the CPI, because both of them go hand in hand. And matter of fact, the CPI data may give us the bigger move next week. So make sure you all stick around. Make sure you stick around for the currency analysis, and I'm going to go over to precious metals and how I feel about the equity markets in general. So make sure you all stick around for that. But before I start in the analysis, make sure if you haven't tried out Forex Analytics, you do so for $1 for 10 days. Download the mobile app when you're trying it out. Because you get a mobile app included with Forex Analytics that gives you all of the analysis about what we're doing, and you get the access to the chat rooms and everything else. But check out Forex Analytics, and also if you want to learn how to trade our money and not risk your own money, check out the Trader Funding Program. It's been a very popular program for so many traders. Every week we authorize, it seems like we're authorizing more checks going out to traders just like you that are trading our money because they didn't want to risk their own money, or maybe they just didn't have access to a larger account, like a $250,000 account, maybe $1 million account. You get to keep 75% of the returns. You don't take any of the risk. You just have to pass an assessment, and the assessment is in a demo environment. So if you want to learn more about the Trader Funding Program, make sure you watch this 2-minute video. Okay, let's get into the analysis of the markets. And like I said just a moment ago, next week is probably going to be the most active week. Well, it's the most active last week of the year, but we're almost at year end. But it's probably going to be one of the most explosive moves that we've seen in a while. Next week has the potential to. Now, I was talking with Chris Weston from Pepperstone, and we were discussing last week about the markets are pricing in the bigger explosive movement to be in the CPI data that comes out on Tuesday. So, make sure that you guys are watching that data closely, because that is the data that could really, really move the markets. Now, you can always get analysis on Forex Analytics just by clicking any one of these tabs. You can have BT stands for Basic Technical, H is Harmonic, EW is Elliott Wave. You have Candlestick and Macro Technical Analysis. So if you want like the current analysis of the market, you can go ahead and always click on one of the 30 instruments here. I'm going to be taking you through the charts live on TradingView so I can draw on them and give you a better view of how I'm preparing for this next week. So let's start with the dollar. And when you look at the dollar, you have to realize it is capped from last week. And let's zoom in a little bit here so you can really see it. And I'm going to delete this really quick, this Fibonacci level, and I'm going to just focus in on like the last couple of weeks. You can see we're in this like descending channel, right? And we're capped by the 200-day moving average. So you got to realize that 200-day moving average is actually going to, play in pretty heavily to this, this analysis going into this next week. Really what it means is a break above the 200-day moving average is bullish, and breaking a new trend lows, then next thing you know, we're testing a lot lower levels. So I'm going to go ahead and I'm going to redraw those Fibonacci's, and let me just I'm going to do this with my own drawings here. Now you'll notice, and let's go a little bit more intraday. You'll notice that we're holding a 78% retracement. That means that at this point in time, we are creating a higher low. That's indicative of what you would consider a consolidation type of pattern, ahead of a big event, which obviously next week is arguably one of the biggest events. So, if you look at the market where we're at on going into weekend, the dollar, is a little stronger here going into weekend, but we might consolidate for the next 24 hours as the market opens because we have the CPI data coming out. Now, if you, unless you missed it, or unless you were, took Friday off, we had CPI data on, or excuse me, producer prices on Friday. We also had University of Michigan inflation expectations come out, and the inflation data, the producer prices came in a little hotter than expected. Now, next week, out of the U.S., we are expecting CPI data to be released, and it is going to be a big release for the markets. So, as we're waiting for that data to come out on, which would be the 14th, we have to keep in mind that data, if it does come in strong, it is going to influence the Fed going into the next week. So what I'd be looking for at this stage in the game is I'd be looking for, to see if the dollar index can make a move back towards the 200-day moving average. Now, when you talk about Fed expectations, there's a lot of people that are really hoping that the Fed pares back some of its hawkish rhetoric that the Fed Chairman Powell and the rest of the Fed governors have really put on over the course of 2022, which has been a primary driver of the markets, as everybody has, the interest rate expectations have risen, and we have a terminal rate around 5%. Everybody thinks that the Fed might be done in raising rates. But the real question is going to be going into 2023, is the Fed going to keep rates at these elevated levels, or are they going to cut rates due to recessionary pressures that are mounting? And history would suggest, especially over the last 20 years, that as the Fed sniffs out a recession, depending on the severity of it, if it does tend to be persistent, they might actually might cut back rates going into next year. And that's why the markets have been, generally speaking, pretty bullish, over the course of the last few months. Last few months, the market has rallied back, and you can see we're testing, the 200-day moving average, channel resistance, very, very important resistance levels in the market. Now, I'm going to give you really quick my hopes in the market, and then my expectation, my realistic expectations. My hope is, just like everybody else, is I hope the Fed actually is just not as hawkish as the market expects. And if there's a little bit of concern or doubt with Fed Chairman Powell this week, the markets are going to really cheer that, and we're going to see, a possible rally going into year end, and we're going to break above that 4,100 level. That 4,100 level is really critical in the S&P. Most of you know that from last week. We talked about how important, over the last couple of weeks, how important this 4,100 level is going to be, and it has been. The only way we're going to break above that is if the market walks away from this week feeling that the Fed we feel that the Fed is going to pare back that rhetoric. It does sound a little bit more, cautious, and that's going to give the green light for asset managers to chase the markets going into year end. However, realistically, based on the stickiness of this inflation, and given the fact that the jobs market continues to be really strong and robust, I don't know if the Fed's going to deliver that to the market. So I think we have to be on guard for a potential sell-off going into the end of the year. And that's not what I hope happens. I'm prepared as a trader to take advantage of either situation. One of the things that we've been talking about on the free F.A.C.E show. Now, if you don't know how to get to our free F.A.C.E shows every single day, you can go to the link down below in the description, sign up for them. You have the Flow show that's delivered by Ryan Littlestone and K-Man and Stelios every day in Europe, and that's free. I'm usually sleeping during those hours 99% of the time. But the F.A.C.E show is where you're going to hear my analysis. You're also going to hear from the European team, and also Dale Pinkert and Stephen Valgaris and other Gregor Horvat, other traders from our team as well. And you can register for that free F.A.C.E show that's every day at 8 a.m. Eastern. So make sure you register for those, because you'll get the most up-to-date analysis from not only myself but the rest of the team as well. So one of the things I've been talking about on the F.A.C.E show regarding what I want to happen, and what I think is going to happen is, you have a Fed chairman that is faced with fighting, high inflation and a very robust jobs market at this point. So if he doesn't sound dovish at all, or just maintains his rhetoric, there's a good chance that the stock market could be 5% lower, which would be, from here to here, 5% lower by the end of the year, or it could be 5% higher by year end and trading above 4,100 by year end if the Fed chairman is a little bit more dovish. Bottom line is, I think that we're at a very pivotal area and we could go either direction, following this week. However, the way I want to try to trade this is I do want to trade with a more bias that the Fed chairman is going to maintain a hawkish rhetoric. So what I would like to do is I would like to be a buyer of dollars on this dip. Now, what that means is, as the euro trades towards 106, as the sterling is near, the 123 level, I am looking actively for short euro, short sterling moves right now, because for a couple reasons. A, the risk reward is very manageable from these points. If you're shorting the sterling, you can see that the risk is that if we're trading around this 123 level, you really only have to risk maybe 70, 80, 100 pips, so a move, let's just say above 124, and you're wrong, but the reward is probably somewhere down here towards 118, maybe even lower than that in the sterling. So when you have a risk reward of maybe, let's just say, I would say, and don't ask me what that was that I just drew, so let me go ahead and get rid of that. Let me just draw a little box where we're currently at. So a risk reward of, you're risking 1 to make 3 or 4. That makes sense to me. And you know what? The good news is, in the event on Wednesday and following Tuesday, if the CPI data comes in strong, and then the Fed chairman is also pretty hawkish, you might have a trade where it could really go in your favor. But if the Fed chair just sounds a little bit more dovish than we expect, then you get a reversal higher, and that a move above 123, a big move above there is probably going to generate a move towards 128. So you have more of a stop reverse type of situation in the sterling. Euro is a very similar situation. If you look at the euro, the previous bull flag pattern that we were looking at, and you can actually let me delete this really quick, and let me do a little bit more drawing for you on the euro. If you want to make it even a little bit bigger and start thinking about like longer term, what we could do here, the euro might actually have a move that could take us, towards the 110 level going into year end. If the Fed chairman is dovish, then that is entirely a possibility. And you would know that a move above 106 is going to be a big deal. Why is a move above 106 in the euro dollar a big deal? Well, not only is it horizontal resistance, but it's also a 38% retracement of this massive drop that we saw from January of 2021 to the lows this summer in 2022. That's a 38% retracement and horizontal resistance, and we're above the 200-day moving average. So if we clear 106, there's the potential for a much bigger move brewing for the next few weeks going forward until we get into 2023. So right now, the risk reward, same thing as the sterling, the risk reward trade, and let me zoom in a little bit here, okay, is here's current price. If your stops are here and you're looking for a move maybe back below the 200-day moving average, you have a basically 1 to 2 or 3 risk reward setup for dollar longs. And if you find out that you're wrong by midweek because of the CPI, because of the Fed, then you can stop and reverse and get on the long side, and you have plenty of opportunity going into year end. And then also what's going to happen with weaker dollars, if the dollar is weakening following the Fed on Wednesday, who else is coming to town? Well, Santa Claus is coming to town, and then you might get that Santa Claus rally that also transpires in the market. I know a lot of you might be predisposed to trading the US dollar, Japanese yen, and this is a chart that we talked about last week. The dollar yen is a little bit more of a mixed signal to me, because you have to factor in what's happening in bond yields at this point, and the bond market. And I'll show that to you here in just one second. Let me delete this, and let me remove that. For some reason I can't grab it, so I'll just grab this one. There we go. Okay, so with the dollar yen, you do have the 200-day moving average here, but I think we're more influenced by yields. And if you look at the 10-year bond market, I mean, the bond market tried to get a move above previous support. That was its current resistance. We broke above it, but now we have this wedge. If the bond market is reversing and we're starting to see a move down in bonds, that means yields are going up. That means that you're going to have the dollar that's moving higher, and it might be moving higher against the yen. It might be pushing the euro around, but the bond market is a little bit more, I think it's a little trickier at this point. I think a more straightforward trade is the dollar outright, or trading the euro dollar or the sterling, versus trying to mix the yen into a move where the yen might be more influenced by what's happening in the bond market versus what's happening in equities. Now, going back to equities, I'm gonna talk about the S&P really quick, and let's talk about like our trading plan here. And I don't know if I'm going to be trading the S&P quite as aggressively as I'm going to be trading currencies, but let's take a step back and let's think about what is happening in the equity markets. We know we're in a bearish trend. We all know that we're faced with a nasty recession going into 2023. What could be a nasty recession, but that doesn't mean that we can't go higher for the next few weeks. If the Fed chair sounds a little bit more dovish, well, that means the S&P probably has some room to rally above 4,100 and maybe even get towards 4,200 over the course of the next few weeks. Maybe 5% higher from here. Now, I hope that happens. I hope the Fed chairman's dovish. I hope we get a rally, and I hope we break back above the 200-day moving average, because I think that's going to provide us a lot of great opportunities to be on the short side going into 2023. Short risk, long dollars, et cetera, et cetera, et cetera. Now, again, what I think is going to happen is that we are going to have sticky inflation. We are going to see a Fed chairman that is going to, stay relatively hawkish, and that's why I'm playing dollars on the long side right now. And if the S&P does break through this 3,900 level, that should usher in some selling back. Here's the 200-day moving average, maybe back towards 3,700 over the course of the next few days. And then instead of Santa Claus delivering us presents, Santa Claus might deliver the market some coal going into year end. Unfortunately, that is my base case. That's what I expect to happen. I just hope that it doesn't happen. I hope we get a rally going into year end. I think it'd be easier to trade not only into year end, but also it'd be easier to trade going into 2023, being able to sell risk at a higher level from up here versus trying to navigate, what to do with the equity markets down here going into 2023. So, like I said, what I hope for might be completely different from what the outcome is. I'm hoping that we get a rally in equities, but I'm really preparing for more of a sell-off initially, and I'm expecting the Fed chair to really kind of stand his ground. He was made to look a fool at the beginning of this year as transitory inflation didn't transpire, and we got very, very high and rampant inflation. So I think the Fed is going to try to stick around and fight that battle and make sure it's won before showing more of a dovish hand. Anyway, let's hope that's not the case, but realistically, that's probably going to be it. Now, I do want to talk about precious metals, because precious metals or gold has been a really interesting setup. As you can see with the gold market is still struggling at this 1800 level, but it's a clear break higher. Let me get rid of these drawings here. Let me just get rid of this. We don't really need that either. because this was more of a hope type of trade, a few weeks ago. I was hoping we'd set up some sort of head and shoulder pattern. But if you look at the gold market is holding, very, very tight around the 200-day moving average, but we have a clear resistance at 1810. In the event that risk rallies and you see a move higher in stocks and the Fed chairman is more dovish, you should see dollar weakness and gold strength. A gold breakout above 1810 is a very, very clear, breakout point to me. That's something that I would play if I'm going to trade the gold market. I'll probably be trading synthetic long gold by being long euros or long sterling, but the gold market, I think, is prepared for a massive breakout on a dovish Fed. Now, if inflation is strong and CPI is strong and the Fed chairman does not budge, very similar to like the euro or the sterling, you have a really good short setup. One thing I have to mention about gold is if you look at silver has been, very, very strong gold, and it has been outperforming gold. So as silver you see how it's outperforming, it's keeping gold very well bid. The problem that we have in silver is that it's rallying and it hit new highs. It hits the 618 retracement. You can see it right there. Longer term 38% retracement, but the relative strength is divergent down below. And when you have divergent relative strength, that really questions the validity of how strong these precious metals really are. So gold might be a good setup right now, especially if you get for a short, if you get strong inflation, so a good strong CPI number on Tuesday, sorry, and then if you get a hawkish Fed chairman on Wednesday, then gold will probably slump back towards the 1700 level, I would think. But we have a very pivotal area. You can see it by that red line. It's above or below that. You can call it the bull bear line. While you're below it, you're bearish. You get above it, you become bullish. It's quite simple, that straightforward analysis. Now, if you guys and gals think that the only thing that's happening next week is the CPI and the Fed, you're wrong. We have the Bank of England, we have the European Central Bank, and there will be expectations flying around by midweek. But for me, I'm the way I'm factoring my week next week is in two parts. First we want to get past the CPI and the Fed on Wednesday. Once we get past that, then we'll start looking at other central banks, like we have the Swiss National Bank, we have the European Central Bank, we have the Bank of England on Thursday. We have PMI data on from European PMIs coming in on Friday, PMIs in the U.S. on Friday as well. Other central banks that are meeting. Let me. We have the Norges Central Bank. It's also meeting. You have inflation. You have retail sales, unemployment data, house price index out of China. On Wednesday night, which will be Thursday morning in Asia. There's let me see. You have Banxico interest rate decision. I should probably just go over the dollar MEX really quick, because the dollar MEX, I believe, is in a really, really tight trading range, and I'll show you exactly what that trading range is right at this point in time. I do trade a lot of Mexican pesos, and I think many of you do as well. And one of the things about this dollar MEX is it's really boxed in here between this 1962 level and 1980. It's capped by 1985, but you could just roughly say it's around 1980. You can see that the dollar MEX is really boxed in here. We might have a stronger, more hawkish Fed allow for a breakout higher in the dollar MEX, because look at the technical setup, right? This is a very impulsive move. I just want to show you really quick. Let's do it on a 4-hour chart. This will be a better view here. So you have a very impulsive move, which would be like the flag stick. Then you have like a pennant that's developed and a breakout like this. So on stronger CPI, expect a continued squeeze in the dollar Mexican peso, a more hawkish Fed. Then you have a potential move towards 2040, and then you have Banxico, which Banxico has been just trying to keep up with the Fed with every interest rate decision. They're expected to raise rates by 0.5%, as is the Fed, half a percent or 50 basis points. So, but if Banxico maybe sounds a little bit more dovish, maybe that is what puts the dollar Mexican peso up towards 2040. Obviously, everything below 1960 is then bearish. This has been one of my favorite trading currencies of 2022. Most of you all know that I've been leaning, short dollar mex all this year. All this year, I've just been trading it to the short side, but it has been a little bit trickier over the course of the last couple of weeks, and I've been actually trading it on both sides of the market over the last couple of weeks. So I think the dollar mex is a great setup going into this next week as well. So traders, I hope you all enjoyed my my playbook going into the FOMC this next week. It is a lot of data coming out. Remember, we have the CPI, we have the Fed, we have the Bank of England, we have the Bank of the European Central Bank, the Norges Central Bank, Banxico, I'm sure, Swiss National Bank. It's central bank mayhem going into next week. So make sure you keep your head on a swivel. You're always watching your six, keeping an eye behind you. And there's no better place to be doing all this than in the Forex analytics community. So come join us every morning on the F.A.C.E show. Guys and gals, I hope you enjoy the rest of your weekend. I'll see you Monday morning on F.A.C.E with the Forex Analytics team members. Have a great remainder of your weekend. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.